Hi, I'm Max Phelps and I'm one of the mortgage brokers at Golden Eggs Home Loans. Welcome to our series of videos where we'll help you understand how to buy and hold more property over the long run. Today's topic is offset accounts, and part 1, offset versus redraw. Now if you've already heard of an offset account and heard that it's somewhere to have all your pay going into and save money on your home loan, then I'm going to ask you to forget what you've heard so far and start at the beginning with why an offset account exists. To do that, let's look at the difference between building money in an offset versus paying down your home loan with the ability to redraw funds from the overpayment. Now, if you're never ever going to invest in property, there's no difference between the two. But if you're an investor or a first home buyer with potential to keep your first home as a future investment, then there's an important difference. Let me explain. A traditional loan is a bit like a bucket. Let's say you have a loan of $600,000 and you have the ability to pay an extra $100,000 into that loan, which takes the balance down to $500,000. The bank calculates interest daily on the balance of your loan. So when you only owe $500,000, you only get charged interest on $500,000. That $100,000 extra that you've overpaid is often available as redraw, which means that they'll let you have it back out, and depending on the lender, some will even let you have an ATM card to draw that money out. Now the problem is, if you actually draw the money out, it could have an important consequence. And that's because the ATO sees redraw as a new loan for tax purposes. Let's say this was your first home and you wanted the option to keep it as an investment property when you upgrade to your next home. Now if you paid $100,000 off that loan while you were living in it and then redrew the $100,000 to put down a deposit on another home, then the bank will say that you've got one loan for $600,000. But the ATO will say that you've got two loans. One loan for $500,000, which is for investment property, and one loan for $100,000, which is for your new owner-occupied property. The bank will be charging you interest on $600,000, but the ATO will say that you can only claim tax deductions on the $500,000. And that's why the offset account was invented. It lets you have a loan account of $600,000 and a separate linked account to it called an offset account, which lets you place the $100,000 in it. The bank will charge you interest on the difference between the two. Technically it's additional because one is negative and one's positive, but they'll charge you interest on $500,000. That means that while $100,000 is in the offset account, the interest you pay is identical to the redraw scenario. The difference comes when you take the money out from your offset account. You simply use the $100,000 as your deposit for the next home, and all of the interest charged on the original $600,000 balance is tax deductible if you use that first property as an investment. Now, I'm not an accountant. You should speak to a qualified accountant and get your own tax advice. But as an investor, I'd rather have an extra $4,000 to $5,000 as a tax deduction. Now, in part 2, we'll look at some of the other benefits of the offset account.